Welcome back to Talk Tickers. Today, we are opening up the hood on what is arguably the single most important bellwether for New York City real estate.
Definitely. We're talking SL Green.
Exactly.
Yeah.
I mean, if you've been doom scrolling all those articles about the death of the office or, wondering if return to office is real or just a myth.
This is the ticker to watch. It's the landlord of New York City.
It really is. So it's late January 2026, and SL Green just dropped their Q4 2025 results.
And the stock popped about 2% right after, which, is a cautiously bullish signal from the street.
A very cautious signal.
Yeah.
But before we get into the nitty-gritty, I want to talk about the vibe. For the last, 2 years, covering this sector has felt like writing an obituary.
Oh, absolutely. It was all survival mode, just pure defense. How do we keep the lights on? How do we stop the bleeding?
How do we convince the bank not to foreclose?
Exactly. This
Yeah.
call. This felt completely different. This was execution mode. The panic, that whole office apocalypse thing, it feels like it's fading.
And now the conversation is about refinancing leasing velocity.
And this massive flight to quality that we keep seeing.
Okay, so we have a ton to unpack in this deep dive. We'll hit the headline numbers, dissect a massive $7 billion refinancing plan.
And we have to talk about why 6th Avenue is suddenly the new Park Avenue.
And of course, we will wrap up with our not financial advice segment. I hear it involves holiday vacations and phone bills.
You heard right. We're going to leverage human laziness.
I love it. Okay, but first, the scorecard. If you're a casual observer and you looked at the GAAP earnings per share for Q4, you saw a loss, a big one, $1.49. That looks bad.
It looks like a disaster if you don't know how to read REITs, right? Real estate investment trusts. That GAAP number is just full of noise.
Mostly depreciation.
Mostly depreciation. It's an accounting fiction where you pretend your billion-dollar skyscraper is losing value on paper every year.
So as sophisticated listeners, we ignore the paper loss and we look at the cash flow.
Exactly. You pivot to the signal, which is funds from operations, or FFO, and that came in at $1.13 per share.
And that's the beat.
That is the beat. Topped the street's consensus by 2 cents. But I think the quality of the beat is what matters more.
How so?
It wasn't financial engineering. It was driven by higher net operating income, NOI, lower expenses, and really strong leasing. They're just running a tighter ship.
Let's talk about that leasing. Occupancy, that's the number everyone obsesses over. Where did they land?
They ended the year at 93.0% Manhattan same-store office occupancy.
Which is a very strong number. You have to remember where we came from.
Oh, yeah. That's up about 400 basis points, so 4% from the absolute lows of Q1 2024. I mean, back then, the story was these towers would be empty forever.
Right. But, and there's always a but. They technically missed their own guidance. They guided to 93.2%, so they missed by 0.2%.
They did. And the explanation for this was, I think, the most human moment I've heard on an earnings call in years.
I love this detail. Steve Jarrell's their leasing director. He's a legend.
A total legend.
He basically had to explain that, yeah, the deals were there, the contracts were on the desks, but it was December.
Right. And the tenants decided they would rather, and this is a quote, enjoy the holidays with friends and family than answer his phone calls.
It's the friction of reality, isn't it? You can build a perfect financial model, but you can't account for a CEO who just wants to drink eggnog for 3 weeks.
Exactly. But the key is the deals didn't die. They weren't canceled. They were just delayed.
Because they pushed right into January.
Immediately. They've already signed 142,000 square feet in January of 2026 alone. So that 0.2% miss, purely timing.
Let's zoom out on that demand picture. The leasing volume was huge. Q4 alone was, 767,000 square feet?
Banner quarter. And over 2.5 million for the full year 2025. The pipeline is still full. Over 1 million square feet in the funnel right now.
But it's not just the volume that stood out to me, it's the geography. We always talk about Park Avenue as the gold standard.
The master of the universe address, yeah.
But management dropped a pretty bold line on this call. Yeah. They said 6th Avenue is the new Park Avenue.
I know, it sounds like marketing spin, right? 6th Avenue is corporate, sure, but it's not Park.
Is there any data to back that up?
I was skeptical too, but yeah. Rents are rising dramatically on 6th. And they gave this incredible case study, 1185 6th Avenue.
Oh, 1185. This was supposed to be the disaster scenario, wasn't it?
On paper, it was a train wreck. They had 4 huge tenants leaving, 700,000 square feet of roll-offs. In a normal market, a building that loses that much space, it goes dark. You hand the keys back to the bank.
I mean, 700,000 square feet is bigger than most office buildings in other cities?
A massive hole to fill. But the disaster just It didn't happen. They've released or have deals pending on almost all of it.
All 700,000 square feet.
All but 24,000.
Wow. That's statistically wild. What does that tell you about the market?
It proves the depth of the high-end market. It's not just about any office anymore. Companies want good office space, and they're willing to pay for it on 6th Avenue. The big tenants are consolidating into better buildings.
Okay, you can't talk about demand without talking about the robot in the room. Artificial intelligence.
The fear narrative.
Right. The narrative is AI makes workers obsolete, companies need fewer desks, office demand collapses. It's a logical chain.
It is logical, but the data on the ground is it's refuting it completely. S.L. Green was very explicit. 0 instances of downsizing due to AI.
0.
Literally 0. In fact, they're seeing the opposite. Tech is back. They cited 13 known AI-specific requirements currently in the market. That's 1.2 million square feet of new demand.
So these AI companies aren't just living in the cloud.
No. They need a place for engineers to sit and collaborate. It's becoming a net new demand driver, not a destroyer.
So looking ahead, they're feeling pretty good about 2026.
Aggressively confident. They're targeting 94.8% same-store occupancy by year-end.
Which is basically full employment for a building.
And they're projecting same-store NOI growth of 3.5% to 4.5%. That's the real signal. It means they have pricing power.
But you can fill the buildings, but can you pay the debt? This is where it gets really interesting, the capital market side.
The $7 billion plan.
Let's unpack that. $7 billion. What are they doing?
It is a huge number. It's all refinancing activity for 2026. Refinancing their crown jewels, 1 Madison Avenue, 245 Park Avenue, and their corporate credit facility.
And this is where the rubber meets the road, because we've been hearing for 2 years that commercial real estate is uninvestable.
That banks are running for the hills, yeah. But the numbers they shared tell a very different story. They just priced the financing for Park Avenue Tower.
Okay.
A 5-year fixed mortgage at a spread of just 1.58%. The AAA tranches of that debt sold at only 112 basis points over treasuries.
Okay, let's pause there. 112 basis points over. Translate that for the listener who doesn't live in the bond market.
Yeah.
Why is that number such a big deal?
So think of the spread as the fear premium. Lenders charge you the base rate, which is treasuries, plus a premium for the risk you won't pay them back. When everyone's terrified, that spread blows out.
So a wide spread means I'm terrified. A tight spread means I'm shill.
You got it. And 112 basis points. That is tight. That's the market saying this asset is safe. The fear premium is evaporating. The plumbing is unclogging.
And it's not just domestic money, right? The CEO, Mark Holliday, just got back from Asia.
The return of the Asian bid. This has always been a legendary force in New York real estate, and Holliday said the appetite to invest in New York is as strong as I have ever seen.
He had that great quote. He said, global investors view NYC Midtown real estate as the real estate equivalent of U.S. Treasuries.
It's a powerful analogy. It's safety, but with a real yield. Yeah. And there's a currency play here, too.
Because the dollar has weakened a bit?
Absolutely. So if you're holding yen or yuan, New York just went on sale. You get a discount on the asset, and you get the yield. It's double tailwind.
So the debt markets are thawing, foreign equity is coming back. Right. What about selling assets to recycle that capital?
They're targeting $2.5 billion in asset sales for 2026, and they already put points on the board. They sold a 49% stake in 100 Park Avenue to Rockpoint.
And Rockpoint is very smart institutional money.
Very smart. And they bought in at a valuation that validates the assets are worth way more than the public stock market implies. It's the classic arbitrage. Management is basically saying the stock market is wrong and we have the private market receipts to prove it.
Let's zoom out a bit to the macro picture. Management talked about the city itself and the new mayor, Mandami.
The Mandami administration. Yeah, they seem cautiously optimistic. They use a very New York proxy for competence.
Snow removal.
Snow removal. A foot of snow fell, and it was apparently cleared quickly. Management used that as a sign that the new administration is getting their arms around the city.
It sounds trivial, but for a landlord, basic city competence is everything.
It's huge. And speaking of competence, let's talk about their biggest tenants, Wall Street.
Because office demand is a derivative of banking employment.
Exactly. The big 5 banks, their earnings were up. Investment banking revenues up 12.6%. When bankers make money, they hire people. When they hire people, they need desks. It's the circle of life.
Okay, one last specific asset. The Summit, the observation deck.
the cash printing machine with a view, they did note a slight drag in Q4.
The glass elevator, right?
Ascent, yeah. The premium experience, it opened late, so there were some costs. It's a reminder they're in the hospitality business now, too.
And one last note on the dividend. They're shifting from monthly to quarterly. That spooks some people.
Retail investors love that monthly drip, but management was pretty clear. They're focusing on total return, not a volatile monthly metric. They're managing for the long term.
Which brings us to our favorite segment, the part where we stop being analysts and start being creative.
Please tell me this is not financial advice.
This is absolutely 100% not financial advice.
Yeah.
We are two voices on a recording. This is for entertainment purposes only. But if you were pitching a wild idea based on this call, what would it be?
Okay, I've got one. I'm calling it Long Steve Durrell's Voicemail Short the Calendar.
I am intrigued. Go on.
The thesis is simple. Management explicitly blamed the Q4 miss on tenants enjoying the holidays, but then those deals signed immediately in January.
So the demand was just delayed by holiday parties.
Exactly. The demand was real, the calendar was the enemy. So here's the trade. You buy out-of-the-money call options on SLG expiring in February to catch the January announcements.
You're playing the lag.
And you fund it by selling puts in December. You are shorting December productivity.
You are literally betting on human laziness.
I am arbitraging the holiday laziness spread. No one signs a 10-year lease on December 24th. Everyone signs on January 15th when the bonus hits. The market punishes the stock for the miss. You capture the rebound.
It's cynical. It's based on human psychology. It's perfect.
I even have a bonus leg to this trade.
Boom.
Go long elevator maintenance companies.
Because of the Ascend elevator at the summit.
You got it. If they're spending money fixing fancy glass elevators, someone's getting paid. Premium vertical transport is the new alpha.
Premium vertical transport. I'm using that. Okay, let's wrap this up. Give us the final recap.
SL Green beat on FFO. They missed slightly on revenue, but the real story is that climbs to 93% occupancy and the tightening credit spreads. The financial plumbing is fixing itself.
And the private market, with guys like Rockpoint and the Asian investors, are valuing these assets way higher than the public market is.
And management is betting $7 billion that the private market is right.
So the final takeaway, if you're looking for office space,
don't ghost your leasing broker in December. Just sign the lease. Steve Durrell's is waiting by the phone.
Keep watching the spreads, everyone. Thanks for listening to Talk Tickers. We'll see you on the next deep dive.